A very good evening, friends. Pretty cold weather in Delhi and chilling. So we are almost on the last phase of consolidation, and we were doing Ind AS 28, and there is some portion on Ind AS 28 which is pending, and then we're going to take to the journey on Ind AS 27 as well. So the agenda for the day is some remaining issues on Ind AS 28. I typically have two agendas to discuss with you on Ind AS 28. One is we're going to talk in terms of exemptions which are available under Ind AS 28. When a company is got a choice that it may not apply an equity method, though I gave you a little inputs in the previous class, but today we're going to do a little more big dip into it. And we're going to see what are the cases when an entity gets a choice in terms of applying an equity method. Well, typically, I would say it is para numbers 17, 18, 19. Well, you don't need to remember the para numbers. I just like them, so I remember them as well. So we're going to concentrate on the exemptions available under the standard. That's one agenda. Then there is an appendix in the standard Ind AS 28, which talks of long-term interest. That is, other than equity shares, there may be, let's say, for example, some long-term loans or maybe some kind of preference shares which the investor has invested in the associate, apart from the equity shares. So there is going to be some special issue which could trigger, especially when the associate company is loss-making. So there is a particular illustration in the study material which is concentrated on the appendix to that particular standard. So these are the two agendas, and then we've got Ind AS 27, though it's a very simple standard, nothing much complicated. We have done some discussions here and there. So we'll quickly touch upon the aspects of Ind AS 27 as well. So I think let's begin the journey. So I'm going to first of all take you to the para number 17, 18, 19. So we're going to read. I know it's going to be a little complicated affair. Don't worry. I guess it would take almost around 45 minutes or so, maybe a little plus minus. Could be a plus. Where you're going to get a complete hang of these three paras. We're going to do some good case studies as well. So you need to hear all these things with a very patient mind. So I'm going to start the journey in terms of exemptions with you. So let's begin the journey. Okay, I think Shruti tells me, "Thand to kam hone ka naam hi nahi le rahi." You're right, absolutely. Thand बढ़ती जा रही है. So I think let's keep the temperature outside. Classroom के अंदर भी उसको लाते हैं. Okay, so on that note, I guess let's begin the journey. So I'm going to take you to the concept of exemptions one by one. I'm looking at the para number 17. I'm looking at the para number 17, where the heading is very clear: exemptions from applying the equity method. Now, watch this carefully. I'll explain the inputs word by word to you, so you're going to get absolute expertise on the area. So let me first read what is stated in para number 17. It says an entity need not apply. So when we say need not apply, it indicates that you get a choice. It is an option. It is not supposed to be mandatory in nature. So you're giving a choice to the entity. You want to apply equity method, you can. You don't want to apply equity method, you may not. So it says an entity need not apply the equity method to investment in an associate or a JV if the entity is a parent. So he says entity would get an exemption if the entity is a parent that is exempt from preparing consolidated financials by the scope exception in para 4A of Ind AS 110. I think let's concentrate only till this stage. So he's just trying to remind me what we did in the very first class of Ind AS 110. When I gave you that para number 4A has got a total of 4 conditions. Let me, I think, quickly remind you the thoughts. So let's say, for example, we've got 3 companies in a chain. And let me also remind you that para number 4A of the standard 110 triggers only when there is a chain. Remember that this para is going to trigger only when there is a chain holding, and we're focusing in terms of the middle company. Now, what we did, That is, A's got a control over B and B's also got a control over C. Now, we said B will be given a choice of not consolidating if he's able to fulfill a total of 4 conditions. And the conditions which we did was number 1. B is either a wholly owned subsidiary of A, or it is a partly owned subsidiary of A, and the NCI has no objection that they does not make a consol. Second, B is not a listed company. Number 3, B is not in the process of listing either. And number 4, the ultimate or intermediate parent in the given example A is making a consolidated financial statements for public use as per Ind AS. So it was for public use as per Ind AS. Then we told B that you may not consolidate C. So he is reminding me the same fact. Now, in this particular diagram, let's add another thing. Let's say B is also got, let us say, a significant influence over D. It could be a significant influence resulting in D being an associate, or it could also be a case where B has got a joint control and D is a JV. Mind the words carefully, because we're looking at a significant influence, or we're looking at a case where B has got a joint control, but then D needs to be a joint venture. Only then 28 applies. So in this particular case, since B got an exemption not to consolidate C under Ind AS 110, by default, the standard 28 also gives B an exemption that you did not consolidate D under Ind AS 28. That's what it says. It says an entity, in my example B, need not apply the equity method to investment in associate or JV if B is a parent that is exempt from Ind AS 110. I hope I am pretty clear. Since I'm going to go very technical, I'm going a little slow as well so that you understand every bit of what we read and understand. Don't worry, notes will be given to you later. But right now, you just need to focus in terms of learning, because I'm going to do some very interesting case studies. And one of the case studies which came on this area was in the RTPs. And one or two very interesting case studies are given in the education material also, which I'm carrying with me at this stage. So I hope I am pretty clear so far on the interpretation. Okay, and Mansha, you said, so these were exceptions and not exemptions. Well, I think, let me remind you, yes, this was giving you a choice. This was not something mandatory. It was optional in nature. Correct. Okay, then he says, or if all the following apply. Or if all the following apply. And trust me, in this particular case, A, B, C, D, these are all the conditions which are there in Ind AS 110 itself. They're all the questions which are there in Ind AS 110 itself, which means, let's take an example. So let's say there is a company A and there is a company B and company C. A has got a control over B, and B has got a significant influence or a joint control of C, and C is a JV. So B has got a significant influence on C, or B has got a joint control over C, and C becomes a JV. Now, we are looking at the focus in terms of B. It says the entity is a wholly owned subsidiary or is a partly owned subsidiary of another entity. Yes. Let's assume that B is a wholly owned or a partly owned subsidiary. The B's debt equity securities are not traded. B is not in the process of listing either. And the ultimate or intermediate parent produces financial statements for public use, and they are within Ind AS 110, which means that if B wants to avail the exemption for the associate consolidation, he needs to prove the same conditions which is proven in terms of Ind AS 110. So let me now say something, and you can vouch me. You can vouch me very carefully. I'm looking at the word or. So my mind is telling me that para number 17 is giving you two situations. Number one, it is giving you a situation where the company is also a parent and also an investor in an associate. I repeat. If you look at the initial para which is given in the standard, it is telling me that B is an investor which has got a subsidiary and associate both. And the other situation, or, is talking of a situation where B does not have a subsidiary, but it only got an associate. Am I thinking correct? Vouch me on this. Can I say in one case, I'm looking at a chain where B has got a subsidiary and associate one, and the other one I'm looking at a chain, but B does not have a subsidiary. It is only got an associate company. So I think let's get the inputs on your side. So is my thought very clear? That para number 17 has got two situations. I hope I'm very, very clear so far. So we're looking at a situation that if B got an exemption under 110 for the chain of ABC, that means B got an exemption to consolidate C under 110. By default, we're telling him that 28 also exempt. Great. And maybe he's not got a subsidiary, but still you fulfill all the four conditions which are there in 110, and you tell him, boss, you don't need to consolidate C. But in any case, A would definitely consolidate B and C in this case. A would be consolidating B as well and C as well. And in this case, A would be consolidating B, C, as well as D as well, because he's got an associate through a subsidiary as well. Okay, so I hope I am pretty clear. You want me to give you notes on each para one by one, or you want me to give you notes at one go after and done with all three? I don't know, you got a choice. So you want me to first of all give you the notes on para number 17 and then go to 18, notes on 18, then go to 19, one by one, or you want me to give you first the entire concept and then take it? I think giving notes is a little better idea, because your focus would be, very clear on each and every para. So there is no confusion that, when I go ahead, you tell me, no, I'm a little confused on what para 17 said. Okay, so what do you want me to do, friends? Give you notes side by side. I think that's a brilliant idea. Okay, though I think I didn't get much input so far on that, but I guess I'm going to give you notes one by one. So let's, I think, begin the journey. I am first of all making a documentation in terms of application, of equity method. So we're looking at application of equity method. And my focus so far has been on the para number 17. I'm just giving a reference to para number 17, just in case you want to make a reference later and get a clarity on that. So let's give you the inputs on para number 17. Okay, I think one by one, that's what I got the inputs. Good, great. So we can say there are going to be two situations. Para number 17 has got two situations. So we can say there are two situations coming in. And in this particular case, I'm looking at situation 1. ABC. So let's consider there is a company A, there is a company B, and there is a company C. And let's consider there is A, let's consider B, let's C, and let's also consider D. So we can see the chain present out here. So this is the chain present. And of course, the direction of the arrow is important. So let me clearly give you the permutations combination. So these are the two situations which will happen. So we can say A has got a control over B, and B has got a control over C, and B has got a significant influence or a joint control, then D is supposed to be a joint venture. I'm putting it very clear. So either B's got a significant influence over D, associate, or a joint control resulting in a JV. And in this case, we're looking at control. And in this case, we're looking at a significant influence. So let me now put the inputs out here. So we can say, as far as B is concerned, we can say by virtue of Ind AS 110, and just to put para number 4A, so just to put the para number 4A, by virtue of Index 110, by virtue of para 4A, which has got 4 conditions. I don't need to remind you those 4 conditions. We've already documented those conditions to you. So we can say that B, by virtue of para 4A, the 4 conditions are met. So can I say in this case, B gets a choice. B gets a choice to consolidate C or not. B gets a choice to consolidate C or not. So if he meets the 4 conditions, he gets a choice to consolidate C or not. And with the same logic. So with the same logic, we can say in this particular case, B also gets a choice. B also gets a choice to consolidate D or not. He also gets a choice to consolidate D or not. So he gets a choice by default for that as well. So he gets a choice to consolidate C or not. He gets a choice to consolidate D or not, which means simply he met the conditions under 110. By default, he's given a choice under Index 28 as well. Okay, so that was 1. Then let's go to the situation number 2. And in terms of the situation number 2, we can say in this particular case, if B meets all 4 conditions of Ind AS 28, mind you, I'm not writing 110. I'm saying if B meets all the 4 conditions of Ind AS 28, which is same as 110, So though we are looking at the conditions under 28, but they are same as the conditions of 110. So if B meets all the 4 conditions of Ind AS 28, B gets a choice. B gets a choice to consolidate C or not. So he gets a choice to consolidate C or not. Okay, I hope I am pretty clear with both the permutation combinations. I think para number 17 beautifully interpreted with all the permutation combinations indeed. Okay, so let me see if there is any questions coming into your mind as far as this is concerned. Otherwise, I think we are taking this further. Okay, so that is para number 17. Now we're going to go to the para number 18 further with you. Okay, so this was para 17. Now I'm coming to the para number 18, which is another very interesting and a very slightly technical language as well. So we are on para 18 now. It says when an investment in an associate or a JV is held by or is held indirectly through an entity. So when you say it is held by, it is direct. And when it says indirectly, of course, it is indirect. So there are 2 situations. It is held by directly or it is held indirectly through an entity that is a venture capital organization, VC, or a mutual fund, or a unit trust, and similar entities, including investment-linked insurance funds. I think we'll concentrate only on the fact that it is supposed to be a venture capital or a mutual fund or a unit trust, because these companies could be having investments in various companies just to maintain a portfolio. So as a mutual fund company, I would be investing in a lot of companies where I may get a significant influence by default, because I'm trying to create an investment portfolio for the benefit of my members. So I might be investing in various companies and may have a large kitty. So whether it's a venture capital or it's a mutual fund, because what happens that even when you're a venture capital, generally you're given a stake in those companies where you do VC financing. And in those particular cases, just to have a track in terms of decisions taken by those company. Sometimes you may get even around a 49% stake in those company. So naturally telling these company that, boss, you're going to consolidate all the companies where you've got a significant influence is putting a too much burden on them. So the standard setters thought that, there are certain kind of companies which may get a percentage, a significant influence over the investee company, but it doesn't make sense to force them to consolidate using equity method. So they gave a choice. So it says if it is a venture capital or a mutual fund or unit trust, the entity may elect to measure that investment at fair value through profit and loss. Now let me explain. Because we've not done financial instruments, so I think FPTPL would be a little concern for all of you. So let me explain. Well, as far as a fair value through P&L is concerned, it is nothing but what we say. Let's say the investment was acquired at 10 lakh and at the balance sheet date, the investment is 10 lakh. So there has been a change in the fair value to the extent of 2 lakh and you take this change in the P&L. So we say it's a fair value through P&L. So whether it's an increase or it's a decrease, irrespective. So whether there is an increase or decrease, whatever is the change in the fair value, that change in the fair value is captured in the profit and loss. And that's what we call FV, fair value through profit and loss account. So he says you get a choice that you may measure that investment at FPTPL in accordance with Ind AS 109, which is financial instruments. And the entity shall make this selection separately for each associate or joint venture. Okay. Now, I think I want to first of all look at the combinations which are coming out of the para number 18 for my understanding. Well, it very clearly says that if you've got, let us say, directly or indirectly, it says investment in an associate is held directly by these entity or indirectly by these entity. So let me, I think, give you an example. So let's, I think, look at a situation and let's understand. So let's say there is A and let's say there is B. So let's consider we have company A and we have got company B. And similarly, let's take another situation. And let's consider there is company A and let's say there is B and let's say there is C. Now, watch this very carefully. I'll give you the inputs in terms of para number 18. So automatically you'll get the notes as well and you'll get the permutation combinations as well. So when in para number 18, it says that directly or indirectly. So let's first take the case. This is para number 18. And we're looking at the case that it is directly held. And I'm looking at the case where it is indirectly held. And you know one thing very clear that when I say indirectly, let me still ask you, can I say indirectly will always be through a subsidiary? What do you say? When I'm looking at investment in an associate or a JV, and I say that you've got indirect investment, if you recall my discussions in the previous class, can I say indirect will always be through a subsidiary? It cannot be through an associate. It cannot be through a JV. It has to be undoubtedly through a subsidiary only. What do you say? Do you vouch me for that? Okay, Shruti said, as in both cases, para 4A, all the conditions should be satisfied. Yes. If you're looking at the para number 17, where the 4 conditions are there, you need to meet all the 4. Any one fails, you do not get a choice. Right? Okay. So let's now consider that A has got a significant influence. Let me just take you back. It says when an investment in associate or a JV. So in this particular case, it could be a significant influence or it could be a joint control resulting in a JV. Let's get that very clear. So we can say that A has got a significant influence over B, or A has got a joint control over B, but B is a JV, not a JO, because JO doesn't get covered under this standard. And I think that was rightly vouched. Wonderful indeed. Okay. So in this particular case, now what we are saying that A is a venture capital organization or a mutual fund or a unit trust. So it says very clearly that the investor if the investor is supposed to be a mutual fund, or it is a unit trust, or it is supposed to be a venture capital, and he's got a significant influence or a joint control resulting in JV, he gets a choice. Now, what is the choice A gets? What is the choice which A gets? So we can say A gets a choice. A gets a choice of either applying. A gets a choice of either applying equity method. He gets a choice of either applying equity method. Brackets, we can say as per Ind AS 28. He gets a choice of applying an equity method as per Ind AS 28. So A gets a choice of either applying an equity method under Ind AS 28, or he could measure investment in B. He could measure investment in B at FPTPL, fair value through profit and loss. So this is the agenda which is given in terms of para number 18. I hope I'm very clear. So if A is a venture capital, or A is a mutual fund, or A is a unit trust, and he's got a significant influence or a joint control over B, resulting in a JV, I will tell A, you've got a choice. You want to apply an equity method, you can do that. You want to use FPTPL as per Ind AS 109, you can do that. So this FPTPL is as per Ind AS 109, which is financial instruments, which we'll see later. So which means either he applies the concept of FPTPL 109, or he applies an equity method under Ind AS 28. The choice is his. This is one. Now let's go to indirectly. Let's go to indirectly. Now let's say A is got a control over B, and B is got a significant influence or a joint control resulting in a JV. See the chain carefully. When I say indirectly, A has got a control over B through a subsidiary, and it has got a significant influence or a joint control resulting in a JV. And in this case, who is going to be the venture capital? B is the venture capital or the mutual fund or the unit trust. So indirectly held through. Indirectly held through. And trust me, in this particular case also, A would get the same choices. You can say A would get the same choices in this case. He would either apply equity method or measure at FPTPL, because A is going to consolidate C, and he is got a choice either to apply equity method to C, or he's got a choice to use FPTPL. The choice is his. Right, friends? I hope I am pretty clear on the para number 18. Let's, I think, just quickly look at the read once more on para 18, and then you go to the two situations. So let's have a read on the para number 18. It says when an investment in an associate or a JV is held by a VC, etc., or indirectly held through an entity which is a VC, etc., the entity may elect to measure that investment at FPTPL in accordance with 109. So either you yourself is a VC, mutual fund, unit trust, or you through a subsidiary, your subsidiary is a VC, mutual fund, or a unit trust. Okay, I guess so far so good. I hope you are all absolutely clear with this. Okay, I got a question from Shruti. So in para number 17, it was the use of or then. In para number 17, what was the use of or then? Okay, I think, let me just take you back. Well, in para number 17, when I was looking at the word or, this is the word or. This is the word or. Get it very clear. If there is a chain where there is a control in B, control in C, there is a chain holding as per 110. Please mind the words carefully. There is a chain holding as per 110. A got a control in B, B got a control in C. So you would have given a choice to B, not to consolidate C under 110. Has B already met all those four conditions? Yes. B has already met those four conditions, therefore he's getting a choice under 110. So tell him that you've already met the conditions. Take a choice under 28 as well. Got the point? So in the first para, he was saying that B already met the four conditions of 110. And if you've met all the four conditions, don't ask him further questions. Tell him, आपको मैंने सब्सिडी कंसोलिडेट करने से चॉइस दी, एसोसिएट कंसोलिडेट करने से भी चॉइस दे रहा हूं. Right? No further evaluation because four conditions already met. Now, in that OR, A has got a control over B and B has got a significant influence over C. Did you apply the four conditions of 110? No. I did not apply the four condition to 110 because he never had a subsidiary. He never had a subsidiary. So I never applied the conditions of 110. Now I will say, okay, let me check. Do you meet the four conditions of Ind AS 28, which is as good as the four conditions of 110? And if you meet them, I give you a choice. So moral of the story. Here, B would have applied the four conditions of 110 and got an exemption. So he gets an exemption under 28 also because already conditions met. Evaluation already done. In this case, B never evaluated 110. उसके पास सब्सिडी नहीं थी, वो कहां से evaluate करता? तो उसने इस particular case में अब check करेगा four conditions 28 के meet कर जाए, which are same as 110, and you tell him, okay, if you meet all the four, given a choice. Right? I hope I am clear. Okay, the next question I think was, is there any similarity between FPTPL or equity method? Not at all. And I think Tariq, you said, so in case if S situation 2, A will consolidate B as per 110. Well, in this case, A will be consolidating B, C, D, and A will be consolidating B and C. In this case, A will be consolidating B and C under 110 and D under 28. Here, A would consolidate B under 110 and would consolidate C under Ind AS 28. Right? Okay, so I think that is got it. You're most welcome. And then I think I got a question from Bella. You said, is choice available if both A? If both A, I didn't get a question. Can you please put that once again? Okay, so this is done. So that was para number 17 and coming back to the para number 18. So para number 18 is direct or indirect. Let's get it very clear. We've just done two things so far. One is we have done that there is a chain. Para number 17, there is a chain. And in the chain, if you are a company in the middle with a subsidiary and an associate, you can think of exemption under 28. Even if you're in the middle, but you're not a subsidiary, you can still think of exemption under 28. That is para 17. In terms of para 18, there is no chain or there is a chain. So remember, para 17 is a pure chain. The chain is either subsidiary and associate or subsidiary associate. And in terms of para number 18, there is no chain, directly VC mutual fund, or there is a chain and through indirectly venture capital. Look at these situations I did in 17 and look at the situations I did in para 18. I hope I am very clear. Now let's go to the next one. Okay, very much clear. Wonderful indeed. And Shruti sir, I mean on what basis the choice is given between equity and FPTPL? Okay. You know, you'll get your answer in some time because I will explain you when para number 18 becomes mandatory instead of optional. Trust me, I'm going to give you very shortly an inputs in the case study. Till now, what I am saying that you're getting a choice under Ind AS 28. I will prove it to you that when the company is supposed to be mandatorily applying a para number 18 and not a choice. Then I'll tell you what is the link between FPTPL as well as the equity method. Why did the standard give a choice of FPTPL? But the basic rule also at this stage is, you know, FPTPL is like mark to market margin. If you're making investments in a company as a mutual fund company, then my purpose is what? That I want a growth of these investments. I want a capital appreciation of these investments. And if you're making the like M2M approach, what we call is as good as FPTPL. So we are saying equity method is, when you consolidate a investee where you say it's a related party. But in this case, you can say this related party is something which is by default. It is not something by choice. I found that the company in which I invested is, quite a worthy company, and I wanted to make an investment in that worthy company. So by default, I got a significant influence. So why would you overburden me as an investor, especially when I'm not an investor, but a venture capitalist or a mutual fund, that I treat that party as a related party and apply equity method? I think the purpose serves well when you're going to consider the M2M approach, that is a fair value through PL. Right, I guess you would have got your answer, I think, Shruti, on that. Mansha, in other situation, if parties don't have significant influence, Ind AS 109 would apply. Of course, yes. Because if you've got no control, no significant influence, no joint control, you're always a passive investor. And 109 definitely applies in that case. Okay, this was para 18. Now let's go to the para number 19. Wow. That is the last para before we do the case studies with you. So let's have a look at the para number 19, which is a very interesting para. The RTP question is being on this particular para itself. Now watch the language carefully. I'll make the diagrams as well. 17 is closed. 18 is closed. Now we're working on 19. Then we'll go to the case studies with you. It says when an entity has an investment in an associate, doesn't talk of a joint venture. Did you notice? Para 17 is talking of associate and JV. Para 18 is talking of associate and a JV. But para number 19 is talking only for an associate, not a JV. It says when an investment in an associate, a portion of which is held indirectly through a venture capital organization or a mutual fund or a unit trust. The para number 18 was saying that you have got either direct or indirect. Please mind the words carefully. Please mind the words carefully. The para number 18 was telling me that you've got either directly or indirectly, and he was talking of associate and JV both. But para number 19, number 1 is talking of associate, and it is talking of directly, indirectly combined. It says when an entity has investment in an associate, a portion of which is held indirectly through venture capital, mutual fund, etc., the entity may elect to measure that portion of investment at FPTPL in accordance with Ind AS 109. I'll read the further later. Let's take an example. Let's say there is a company A, and let's say there is a company B, and let's say there is a company C, and A is also got in C. Let's take that example to understand the para 19. Now let's say A is got a control over B, and B is got a significant influence over C. He is a venture capital, he is a mutual fund, or he is a unit trust. We can see one thing, that in terms of para number 18, we were looking at this chain A in B and B in C, but I now added A and C. In para number 18, my situation number 2 was the same situation, but I've just added that further part. So let's say A is also got a significant influence over C. Now, please hear this carefully. Every word is going to be very important. You can say A is got directly, and A is got indirectly through a VC, etc., a significant influence. I did not write joint control. So it says when an entity has an investment in an associate, a portion is indirectly held through VC, mutual fund, etc., it may elect to measure that portion at FPTPL. So for this portion, A will apply equity method only. And for this portion, B is got a choice. The portion which is directly held, you need to mandatorily apply equity method. And for the portion which is indirectly held, you get a choice. I hope you got it. So para number 19 is giving you a clarification further on the para number 18. In terms of para number 18, he was saying that you've got either direct or indirect. Now he says direct, indirect combined. But this direct is not that E is a VC. So we are given one is a normal situation that you've got normally and one is indirectly. So you've got basically two stakes. One, you have it in C directly, but you're not a VC. And you've got through B, which is a VC. So the standard says on this portion, equity method, and for this portion, you've got a choice of equity method or Ind AS 109. So you need to see that if there are two portions of the investment, so on one portion which is not through VC, because he is not a VC, you apply equity, and for the other, you apply a choice. Now it says further, regardless of whether the venture capital has significant influence over that portion, it says regardless of whether he has got a significant influence over that portion, which means, now hear me carefully. Let's say A is got 20 in C and B is got 20 in C. A independently in C has significant influence. B independently in C is got significant influence. I don't care if A in C is below 20. I don't care if B in C is below 20. What I care is A in C plus B in C is 20% or more. I put it again. Don't worry, I'll document. So what is important is that A in C is less than 20 or B in C is less than 20. I don't care. Till the point A in C plus B in C added together makes a significant influence. Para number 19 says, I'll give you equity for one portion, I'll give you a choice for the other portion. Technical, slightly technical indeed. Okay, let me just make a diagram and give further notes to you. Okay, I got a question from Bella. So can we have a choice to choose equity method or FPTPL if both parent and subsidiary are a venture capital, mutual fund or unit trust? Well, I guess if you're looking at a similar situation where you say that A is also a venture capital, then he's got directly being a venture and indirectly through B also, then A gets a choice for both the portions as well. Correct. You can create more combinations based on logical interpretations. That is correct. But I'm just giving you a parent what is given in para number 19 as a clarification that one portion is not a case of VC, another portion is a case of VC. Let's, I think, put the notes to you. So I guess I'll put the notes out here only. Let me just add another case out here. So let me pen down the inputs in terms of para number 19. This is para number 19. Let's give you a diagram. And then we'll do case study, because once you know the concept appropriately, trust me, doing case studies becomes very, very easy indeed. If you don't know the concept, then it's difficult to crack a question. If you know the concept, that's the beauty of Ind AS, that you know the inputs and you can just apply simple logic and get the answers. So in terms of para number 19, I am considering only one situation, no further situations. There can be more situations, but I'm taking only one situations simply. One could create a lot of permutation combinations as well. So let's consider A, let's consider B, let's consider C. And let's consider A in B, B in C, and let's also consider A in C. So I'm considering the same permutation combination which I explained. So let's put it like this, that A is got a control over B and B is got a significant influence over C, he is a venture capital or a mutual fund or a unit trust. So he's got indirectly through a subsidiary, and he's also got a significant influence. And let me put it out here, joint control, I'm crossing. Joint control, I am crossing. Now your mind might start working crazy. So I'm going to create some permutation combinations on 18 plus 19. I will not do that. You're free to, create any permutations you want. My idea is to give you some basic knowledge to the extent required in the exams. You can be creators, Brahma, the creators. Okay, so now let's pen it down. So we can say that number one, what is most important is A in C plus B in C has to be 20% or more. So what is important is that the sum total of A in C and B in C has to be more than 20. You add up these percentages, it has to be 20 or more than 20. And let me also clarify, irrespective, it doesn't make a difference, irrespective, A in C or B in C individually is below 20. It doesn't make a difference to me whether there is individually below 20. So on a standalone basis, A does not have a significant influence over C. On a standalone basis, B does not have a significant influence over C. I don't care. So what is important is the combination should create a significant influence. Individually A in C, individually B in C, they do not create a significant influence, doesn't make a difference. So what are we going to do in this particular case? So we can say on this portion, we need to apply equity method mandatory. So we can say equity method mandatory. So equity method is mandatory in this particular case. Let me underline mandatory. So A in C, 100% equity method. And as far as this portion is concerned, so we can say for this portion, so as far as this portion is concerned, we get a choice in terms of either equity method as per 28, or you get a choice in terms of FPTPL, that is Indes 109. So either you apply equity method as per Indes 28, or you apply FPTPL as per Indes 109. Well, that is the inputs in terms of the para number 19. As I said, around 45 minutes, and 45 minutes are done, and I've given you the insights in terms of all three paras put together. I'm sure before I like to take you to the case studies, you would like me to give you a quick consolidation of the insights in terms of 17, 18, 19, so that we can get on to the case studies, because I want your insights. When I do the case study, you're going to give me a helping hand. Okay, so far so good. And I think I've got another question. Okay, that one is done. Shruti, in para 19, how is it direct? A is not VC. That's what I said. Well, I'm not calling it as direct, because when I say direct, it means direct as a VC. So I didn't write the word direct to avoid any confusions, right? Okay, now let's take a quick recap on the agenda. So we're looking at a quick recap on the agenda. So just watch me carefully, relax your minds, and look at the three exemptions in 17, 18, and 19. Get it very clear which para triggers in which case. Now please hear me clear. Every word which I'm going to say is going to be very important, and each and every word is going to be very important. So hear me carefully, relax your minds, and just hear me. Just hear me carefully. When you're looking at the para number 17, keep one thing in mind, you'll definitely see a chain. The para number 17 would not be triggering in a normal case. It is only if there is a chain. And in this chain, there are two kinds of chains. Either it is a control followed by a control and associate, or it is a control and a significant influence. In this chain, the focus is on the middle company. And in the chain, when the focus is on the middle company, you are looking at B in C 110 and you're looking at B in D 28. Now, since a company would have already evaluated the four conditions for B in C, I would tell B, okay, you already met the conditions under 110, so the same conditions are there in 28. You get a choice here as well. So we can say, since B was getting a choice under 110, he is also being given a choice under 28. And since he's already met those four conditions, you don't need to reassess the four conditions back. Next, in this particular chain, we can see that B is the middle company. It is not a parent. It is not a parent. So therefore, it never applied 110. So I think there is a need to look into the same four conditions which are in 28, same as 110. And we tell him that if you meet all the four conditions, we give you a choice. So as an investor in a chain, you've got a subsidiary, associate, you get a choice. In a chain, you've got just associate, you get a choice. That is 17, chain holding. Now let's go to the para number 18. And in terms of the para number 18, we're looking at VC. The focus is mutual fund. The focus is venture capital. The focus is unit trust. Either it is direct, no chain, or it is indirect, there is a chain. But the focus is what? Venture capital, mutual fund, and a unit trust. So if it is not a chain, the investor himself is a venture capital mutual fund, you get a choice. If there is a chain, then in this case also, you still get the choice. So either as an investor, I am mutual fund, VC or UT, or I have a subsidiary, which is a VC mutual fund, I would get a choice for my associate. C is also an associate of A. So A gets a choice for the equity method in this case. Okay, so that was para 18. And then comes para number 19, where you can say that you're holding, two portions. Para number 19 is on portions. Para 18 is chain, no chain, focus, VC, etc. And para number 19 is two investments. So one is a normal investment. This is a normal investment. You apply equity method mandatory. And one is through that same para 18 concept. Through, so you get that para 18 concept. So you've got two portions of investment, one equity method mandatory, other you get a choice, and the choice is available. What is important is A in C plus B in C more than 20 or 20 or 20 more. Individually A in C or individually B in C is below 20, I don't care. C should become associate of A, because if A plus C plus B in C is 20 or more, it is an associate. Right, friends, I guess I am pretty clear. I'm not going to take your comfort zone scores at this stage. I will take it later, once we've done the case studies with you. I think it's time now to take you to the case studies on this area. So let's bring you to the case studies. I'm carrying some questions from the study material as well as from the education material as well. So let's, I think, take you to those questions. Just give me a minute. Wow. So let's have a look at this. I'm going to first take you to question number 6, because I think 5 might get a little confusing. So, I think first I'm going to come to the question number 6. Then I think maybe you can come to the question number 5 after that. So let's have a look at the question number 5. Let me zoom it a bit further maybe. I think if we can, yes, we can. Okay, let's zoom it further. Yes, that's good to go. Now you got to see very carefully the facts. I've already highlighted a few things in the red. This is a question in the education material. I think if you've understood, you will easily relate it now. Let me read. ABC operates a pharmaceutical business and owns a VCO or venture capital V. ABC is got a subsidiary which is a venture capital. We can see something indirect. We can see something indirect through a subsidiary. It says V's business is monitored on the basis of fair value of the instruments. ABC and V hold 20% shares each in Z. He's got 20% in Z. That is without being any permutation combination, and there is 20% here as well. Let me ask you, friends, think carefully and answer. Do you think para 19 would trigger? Give the answer thinking very carefully. ABC is got 20 and ABC is got another through VC. So there is one portion which is without permutation combination. There is another portion which is through a VC. Do you think para number 19 would trigger? Let's get your answer. If you can answer this, your fundas are going very good. Okay, so I think Shruti said, so para 18-19 caters to mutual fund VC, but why not to normal company as well? I think let's not get into that discussion. So we got the answer, yes. We will not complicate things at this stage. Okay, so let's now take it further. You all absolutely correct said, it is undoubtedly a case of para number 19. It is undoubtedly a case of para number 19. You can see that there is definitely a chain. You know, if you want to see this more in a chain, you can say there is a company ABC, and you can say there is a company V, and then you can say there is a company Z. Now you can see it makes something which is like my diagram. You know, if you're thinking the diagram looks a little different. So this V company is supposed to be a venture capital. So can we say on this portion, you would apply equity, and on this portion, you get a choice. So in this particular case, it says, how shall ABC account for the investment directly, indirectly through V in Z in its consolidated financials? So on this part, you are mandatorily required to apply equity method. And on this particular part, you get a choice. Either we can apply an equity method or we can apply an FPTPL as per 109. I think that was pretty simple and straight indeed. Okay, let's now take it further. I think it's time to do the question in RTP. It's time to do the question in the RTP. So now this is the question which is based on the RTP. I think I'll have to slightly clean it to read it further. So let's have a look at the RTP question now. This question is there in the education material as well, and it came in the revisionary test papers as well. Let's read. It says entity P is a parent. It has got two wholly owned subsidiary X and Y, each of which has got an ownership interest in an associate Z. We'll see the diagram. It says X is a venture capital organization. Neither of the investments in associate by subsidiaries X and Y are held for trading. Subsidiary X and Y account for the investments in associate at FPTPL in accordance with 109 and using the equity method as per Ind AS 28 respectively. It says subsidiary X and Y are accounting for these investments as per different standards. But I think let's first have a look at the diagram. So let's have a look at the diagram and then we'll decide further. So there are a total of three scenarios. There are a total of three scenarios. Let me zoom it a bit. Okay, I think it's good to go. Now let's have a look very carefully. We're going to see, I've underlined, darkened red colors on both the things as well. So let me just, I think, create a diagram. It says P is got two subsidiary X and Y, 100%, and each of which has got interest in an associate Z. So I am given there is a company P and it has got a subsidiary X and Y wholly owned. So there is 100% stake in both the companies. So there is 100% stake and each of these company has got a significant influence over Z. Let's look at that. So P has got two wholly owned subsidiary X and Y, and they've got associate Z. X is supposed to be a venture capital, and I am given further that company X is a VC. Here's a venture capital organization, so there is a significant influence. There is a significant influence. Okay, now let's go back and see further. It says subsidiary X and Y account for the investment in Z. X is using FPTPL and Y is using equity method as per 28. How should P account for the scenario? He says as far as X is concerned, he is accounting using FPTPL. And as far as Y is concerned, he is applying equity method. He's telling me what the subsidiary is doing. He is using equity method. And in this case, FPTPL, and he's using equity. Now, I have a question further. If you look at P, is it a case of para number 19 again? One portion which is through VC and another portion which is non-VC. Is para number 19 going to trigger with reference to P as well? Because P has got two portions in terms of Z. One is through X, which is VC, and one is through Y, which is normal. So do you think para number 19 in this case would trigger? Okay, so we got the answer. Shruti, you said in para 19, as it is similar to 18, JV, joint control is excluded. Well, para number 19 is only talking of a significant influence. Yes. And that's rightly said. Yes, the para number 19 would definitely apply in this case as well. So can I say again, when P accounts for the investment in Z, he would also get a choice in terms of equity or FPTPL for this portion, and he would apply an equity method for this portion. So he would apply an equity method or a FPTPL for this portion, and he has to mandatorily apply equity for the other portion. Let's read now 3 scenarios. This is the question, but now he's giving you further scenario 1 to 3. Let's have a read. Where both the investments in associate result in a significant influence on a standalone. X is got 25% in Z and Y is got 20% in Z. X has got 20% or more, Y has got 20% or more. Do I care? I gave you a clarification regardless of the fact whether we can say X in Z is 20 or more, Y in Z is 20 or more. I don't care. What is important is X in Z plus Y in Z is supposed to be 20 or more. What is important is X in Z and Y in Z put together is 20 or more. Individually, any combination, I don't care. That's what he has done. Scenario number 2, when neither investment results in a significant influence, he says X and Z has got 10% each. Doesn't make a difference to me. 10 plus 10 is 20. Para 19 would apply. 25 plus 20 is 45. Para 19 would apply. Third case, one of the investment results in significant and the other investment does not result in significant. X and Y 30, Y and Z 10. 30 plus 10 is 40. He is just testing you that do you understand regardless? Do you understand regardless? That means that X in Z alone is 20 below or more, I don't care. Y in Z alone is 20 below or more, I don't care. What is important is X plus Z, X and Z and Y and Z put together has to be 20% or more. So you can see 25 plus 20, 45, 10 plus 10, 20, 30 plus 10, 40. So in all these cases, the interpretations would remain the same, whether it is scenario 1, 2, or 3. That was a beautiful question, interpreting the para number 19 and also, looking at the clarification regardless. Beautiful indeed. I hope, friends, I'm pretty clear on this particular example. Okay, Shruti said, so in both the questions, we are checking para 19, why not 18? Okay, that's a good question. Let me tell you that as well. What does a para number 18 apply when you are directly or indirectly holding? Agreed. You see, in this particular case, 19 is an extended version of 18. Please mind the words carefully. 19 is an extended version of 18. What is important in 18 is you've got only direct or indirect. And what is there in 19? You've got normal plus through VC. So there are two portions. Para number 18, one portion only. And para number 19, two portions. Do you get the point? Para number 18, if you notice, it is one portion. Direct, one. Indirect, one. In this case, it is one is without any permutation, one is with VC. So there are two. So the triggering point of para 18 is what? If there is one. And triggering point for 19 is what? There are two portions. So the moment it is two portions, you're in 19, not in 18. I hope that clarifies the agenda. Okay. And Y is not, Mansha, you said is a venture capital? Yes. So in any case, if Y is not, then this portion, as we said, equity method would definitely apply. Because if that portion is not held by way of a venture capital, then of course, normal equity method would apply. Okay, so that was the question. Now let's have a look at another interesting question with you. I'm going to go to the question number 8. And this is again in the education material. And then I'll go back a little bit on one of the another interesting questions on para 18. Till now, we have seen only questions on para number 19. The two questions which I've covered so far are purely on the application of 19 because there are two portions of investment. So 19 is triggering. Let's see which one would trigger in terms of 8. Okay, so let me now take you to the question number 8 as well. And this time you're going to decide on which particular para is going to trigger. It says an entity X has got 100% investment in A. So X has got 100% in A subsidiary. And we can see something which is, coming through a subsidiary. And which in turns hold 20% in associate. So there is a 20% out here. So we can clearly see one thing. X is through a subsidiary having in Z, portion 1. Then he says, in addition, X has got 25% in associate B. So this is associate B. And it says you've got a 50% investment in a JV, each of which has got a 10% in Z. I think I did this question earlier also with you, but I thought I'll just do it once again. So it says that you've got a 50% stake in C, and it is a JV, and he's got 10% in Z, he's got 10% in Z. Now, watch this. Portion 1, portion 2, portion 3. Is para number 19 going to be applicable? Think carefully. So we've got 3 portions. Portion 1 through subsidiary, portion 2 through associate, portion 3 through JC. Do you think para 19 would trigger? Let me see what is the answer we're going to get. So give me the input, friends, on this. I'm waiting for your answer. That entity X has got one portion through subsidiary, one is through associate, and one is through a JV. Is this going to trigger the para number 19? Tell me. I'm going to wait for your answer. Think very carefully and evaluate. Do you think that para number 19 would trigger in this particular case? Because there are 3 portions of the investment. So do you think para number 19 would trigger in this case or not? Watch it carefully. You know the triggering parameters when para number 19 is going to trigger. So in this case, portion 1 through subsidiary, portion 2 through associate, and portion 3, which is there. Very good, Mansha. That's exactly right. Para number 19 is not applicable. I gave you the inputs to this example in the previous class as well. And if you recall that when I gave you the para number 5, when I gave you the concept of para number 5, where we were talking of direct, indirect, I did this particular illustration with you. And I said, if you are having indirectly through associate, not considered. If you're having indirectly through JV, not considered. So can I say he's got only one portion, that's it. There are no second and third portion, and even the second and third portion is not through subsidiary. And number two, it's not a case of venture capital. None of these companies are subsidiary, and none of them are supposed to be a venture capital mutual fund as well. Okay, I got the correct answers from everybody. Wow, that's wonderful indeed. Great. Now I think let's take you further. Now a little last question with you. I think we've done enough research in terms of the questions on this area. Now let's come to the question number 5. This is the last question in terms of the para number 17, 18, and 19. I guess let me just slightly clear this out. This is a beautiful para. It's a beautiful question, and you'll love this question. I've intentionally taken this question because this is a icing on the cake. You've understood para 17, though we did not take any questions on 17. We did para number 18. We did not do any questions on 18 either. Our concentration was only on the questions on para number 19. But I think now let's have a look at the para number 18 as well. So let's have a look on this. So let me just read the question number 5. Following is the group structure of ABC. ABC is an investment entity and a venture capital. Aha. ABC is an investment entity which reminds me Ind AS 110, and that reminds me the para number 4B, the capital B. You remember my 3-step model which I give you in terms of investment entity. सर इतने आपने महीने पहले दिया था, किसको याद पड़ा है क्या दिया था? If you remember, I gave you in terms of Ind AS 110 that there were 2 cases. One was exemptions, one was exceptions. And for investment entity, I gave you a 3-step model. The parent is investment, the subsidiary is investment. And then you see if it is not investment, does the subsidiary do the same work as the parent or not? Remember? So this is investment and venture capital. This is a non-investment subsidiary of ABC, and this is also a non-investment associate of ABC. Wow. So I am given that company ABC has got a subsidiary and an associate, the non-investment entity. ABC is a venture capital organization and also fulfills the definition of investment entity as per 110. How should ABC account for the investment in AB and PQ in the financial statements? Under 110 and 28. Now, please hear me very carefully. I'll just remind you one particular input. Please watch this carefully. I'm looking at this part of the chain. I'm looking at this part of the diagram. Then I'm going to look at this part of the diagram. We're going to look at independently. So we're going to look at, first of all, the chain as far as the subsidy is concerned. Now, if it is a subsidiary, I would go to Ind AS 110. And I will put the question number 1. Is ABC an investment entity? Yes. ABC is an investment entity. So you go to step number 2. Is AB an investment entity? I said no, it is not an investment entity. I go to step 3. And in terms of step 3, you need to see that AB does similar work what ABC does. And if I say no, they do not do similar work, no consolidation. If they do not do similar work, no consolidation. So this is based on the 3 steps that ABC is investment, yes. AB is not investment, yes. And AB's activities are not similar to ABC. So in this particular case, if they are not similar, in this particular case, he gets an exemption. Because if they're similar, he has to consolidate. So that means by virtue of Ind AS 110, if the 3-step model is met, am I going to tell him, boss, you cannot consolidate or you get a choice? If you remember, in terms of investment entity, I told the parent company, you cannot consolidate. It is unlike the para number 4 clause A. But in terms of investment entity, I will say that it is mandatory. You cannot consolidate. It is mandatory that you cannot consolidate in this case. Now let's go to the other chain and let's have a look at ABC in PQ, which is an associate company. So in this particular case, I would start applying Ind AS 28 parameters. And in terms of Ind AS 28 parameters, he is a venture capital. He's a venture capital and he's got an associate. Tell me, friends, which para of Ind AS 28 would apply? He's got only one. There are no two portions. It is only one. There are no two portions. He is a venture capital. He's got one portion, which is direct. Do you think in this case, para number 18 would apply? Say yes or no. Do you think in this particular case, the para number 18 would trigger? Think about this and tell me, do you think para 18 would trigger? And that's rightly said. That's absolutely correct. Yes, the para number 18 would trigger. So in this case, if the para number 18 triggers, now what does the para number 18 says? That I am giving you a choice. I am giving you a choice. So ABC is mandated not to consolidate AB. ABC को मैंने बोला इंडेस 110 में आप कंसोलिडेट नहीं करोगे और ABC को मैंने इंडेस 28 में बोला तेरी मर्जी. Is there a contradiction now? Now the interesting part is in order to fulfill the definition of investment entity, this company has to account all investments at FPTPL. In order to fulfill the definition of investment entity under Ind AS 110, he has to consolidate, he has to consider all the investments at FPTPL. He has to, mandatory. So in this particular case, the standard Ind AS 110 tells me that all the investments have to be taken at FPTPL in this case. So Ind AS 110 कह रहा है इसको भी FPTPL पे लो. अगर ये एग्जेम्पशन अवेल करनी है तो ये सारी इन्वेस्टमेंट्स को FPTPL पे लेगा और Ind AS 28 कहते हैं चॉइस. सो Ind AS 110 will override Ind AS 28. Ind AS 110 in this case will override Ind AS 28. This para number 18, which is a choice, will become mandatory in nature, and in this particular case he will have to consider FPTPL only. He will have to consider FPTPL only. I hope I'm very clear. So if you notice that this company ABC is an investment entity and therefore he is told under 110, you cannot consolidate, boss. And he's got an associate and he's sold. Okay, you've got a choice. Then Ind AS 110 tells him you're an investment entity. So both investments to be taken at FPTPL. Otherwise your status of investment entity cannot be taken. So because of the fact he has to account all the investments at FPTPL, Ind AS 110 will override the para number 18, and the para number 18 in such case, which is optional, becomes mandatory in nature. I've given you huge research on para number 17, 18, 19. I think now you can easily do the questions in the study and you can start thinking your own permutations, combinations. Okay, so far so good. Now, I think before we go to the next area, I think it's time to get your scores now at this stage. That is one area of discussion. I've got another area of discussion, which is Appendix D, Appendix to the standard. But before I take you to the Appendix or the standard, I want you to give yourself a comfort zone on the scale of 10 on the understanding of para 17, 18, 19. Let's get your comfort zones. Okay, so that's clear, pretty good. So let's also get your comfort zones, friends. And then in the meantime, let me take it further. So I got a score 8 for Kriti, 9 for Salesh, 8 for Shruti, 8 for Mansha. That is pretty good indeed. I think a score of 8, 9 is pretty good indeed. Trust me, once you go to revise, you'll get expertise 10 out of 10. Wonderful indeed. Okay, now I am going to go further and we've got another area of discussion. we've got another very interesting area of discussion, the appendix to the standard. So let me just make some inputs on the next area, appendix. Now, this is again slightly a little technical area of discussion as well. Sorry. This is slightly again a little technical area as well. Now, what we're looking at is, it says there is a long-term interest in associate or JV apart from equity investments. I think I now need to first make a little background before I read this, because there is a comprehensive illustration which is given related to this particular appendix. So what I'm going to do, I'm going to first of all give you some insights. So let's, I think, first give you some basic insight. Now watch this carefully. I'm giving you situation 1. I'm giving you a situation 2. I'm giving you a situation 3. And I'm giving you a situation 4. Trust me, there cannot be a 5th situation. You need to get a very clear understanding of all these 4 situations. So let me, I think, give you the 4 situations. Let's consider the 4 situations. I'll tell you the inputs in terms of the 4 situations. So let's say there is a company A and there is a company B. So let's say A and B. Let's say A and B. And let's say A and B. Now, let's have a look at this very carefully. In situation 1, I am considering A has got only equity shares in B. That results in a significant influence. A has got only equity shares in B, and that results in a significant influence. And B is a profit-making company. B is a profit-making company. Let me tell you, the appendix which I am going to teach you is not applicable. So if you look at a chain where A as an investor has got only equity shares, he's got only equity shares resulting in a significant influence. And B is a profitable company, the appendix doesn't trigger. You do the usual accounting, apply the equity method under usual way. Let's consider situation 2 where A has got, let's say, only equity shares in B, resulting in a significant influence, and let's say B becomes a loss-making company. It's a hugely loss-making company. So in this case also, A has got only equity shares and it is a loss-making company. Even in this case, the appendix would not apply. Even in this case, the appendix cannot apply. But we have not done this case actually. We have not done a practical example on this case. So I would like to give you a little exposure in terms of the situation number 2 as well, just to get a little clear understanding. Let's say, for example, this investment, A made an investment in terms of B, let's say at 6 lakh. Now, if you remember the equity method last time, I told you that if the associate equity goes down, the investment has to go down. So I told you that equity method is simply a movement in terms of net assets. Equity of the associate goes up, the investment goes up, share in the increase, or equity as net assets goes down, the investment goes down, share in the equity. Now let's imagine this company earned a loss and the share in the losses is 8 lakh. I will not be able to reflect this investment at -2 in the balance sheet. You'll have to show the investment in the balance sheet at 0. So in this particular case, the investment in the balance sheet is going to appear at a nil value, and you will put a note that there is a 2 lakh losses which are being carried forward. They could not be accounted for. So we have not done a question, but I'm just giving you the insight that if the B company is a loss-making company, then A would reduce the investment, but he cannot bring the investment at -2. So he would reflect the investment at a figure of 0 and say in the notes to accounts that 2 lakh is a loss which could not be absorbed so far, but the appendix does not apply. Now let's go to the situation number 3. Let's have a look at the situation number 3. Now, A is got in terms of B equity shares and some other long-term interest as well. He's got some long-term interest as well. You will say, what do you mean by long-term interest? If you recall the concept of Ind AS 21, where there was a concept of net investment in a foreign operation. And we used to say that you've invested in some investments in the subsidiary where the repayment is neither planned nor it is going to happen. So you gave, let's say you gave a loan to your subsidiary company, and when you gave a loan to the subsidiary company, you told them, boss, there is no need to make a repayment. So you're not looking at the repayment of that loan. Similarly, as an investor, you could also invest in long-term interest in the associate company, which could be in the form of, let's say, preference shares, or which could be in the form of, let's say, loans given to the associate company. And these are the kind of loans where you are not planning either to repay them. So there is no planned date in terms of which repayments will take place. So they should be considered as good as equity. That's what the concept of Ind AS 21 also works on, that if you've got net investment in a foreign operation, you got to consider certain investments in the subsidiary, which is, as good as a permanent funding. So you may not do a permanent funding only through equity shares, but there could be other investments, as we said, long-term in nature, for which there is neither a plan to repay, nor it is going to happen in the near future. Now, in this particular case, if B is a profit-making company, then in this particular case as well, the appendix would not apply. The appendix would not apply. So we have got three situations very clear. A is got only equity shares in B, and B is profitable or loss-making, appendix would not trigger. A is got equity plus another long-term interest, but it is a profitable company, the appendix will not trigger. The appendix triggers only when A is got equity shares, A is got equity shares plus other long-term interest in the associate as well, and this company is a loss-making company. So that is a crucial point which you need to understand, that if it is only as an investor, you've got equity shares and other long-term interest in the associate, and the company B associated with a loss-making company. So there are like three conditions which will trigger the appendix. So the appendix to the standard will get triggered in this particular case. So let me put it again, that there are three triggering conditions when the appendix would trigger. If you've got equity share 1, and if you've got other long-term interest 2, and the associate company is a loss-making company, then this appendix gets triggered. So there cannot be a fifth situation, trust me. Because if you're looking at that you've got only equity share, it doesn't make a difference whether associate is profitable or loss. Except that in case of loss, you cannot reflect investment at minus, at zero at the max. And even if this long-term interest is there in that particular case as well, to the extent it's a profitable company, no accounting will be done. These securities will be completely accounted under 109. They will be completely accounted under 109, no impact on 28. But if you've got equity share and other long-term, and it's a loss-making company, then Ind AS 28 would trigger in this case. I hope I am clear with the permutation when this would trigger. Okay, so now with this inputs in hand, I need to now explain you how would this make a difference, that if as an investor, you've got equity with other long-term interest and the associate is a loss-making company, how does the equity method of accounting undergo a change? So we're looking at how does the equity method of accounting undergoes a change if this is the permutation combination. Let's, I think, now take it back. And now with this background, let's read. I've given you enough background, and I think with this background, let's now read the inputs. We're going to do a comprehensive question also on this area in the appendix. Let's have a read. It says an entity may hold financial instruments in an associate or JV other than Investments accounted using equity method. The investments which are accounted under equity method is only equity shares. These include long-term interest that is in substance forms a part of the net investment in the associate or a JV. So as an investor, I am giving certain long-term interest in the SOJV, which is like a permanent funding. It says that is in substance a part of the net investment. So you are saying that, okay, I will not put the money only by way of equity share. I'll also pump in money by way of long-term loans in your company, which is as good as a permanent funding. If it is as good as a permanent funding, then we're going to trigger this standard. For example, an item for which settlement is neither planned nor likely to occur in the foreseeable future is in substance an extension of the equities investment. Indirectly, we are saying that these kind of funding, which is long-term in nature, creates this kind of a funding, which is long-term in nature, creates as good as a permanent funding. You should consider them as good as equity holding in the associate. Okay, now he gives us examples. We're also given some examples of which item are going to be considered for this particular purpose. So let's have a look at which particular investments are we going to consider. It says such items may include preference shares and long-term receivables alone, but they do not include any trade receivable, trade payable, or long-term receivable for which adequate collateral is present. So what is important is that as an investor, you've got in the associate or in the JV interest which is long-term in nature. Long-term receivables, long-term loan, not trade receivable. So there is long-term receivables alone, not trade receivable. There is supposed to be a preference shares, etc. Any short-term things with them. If you've entered into a debtor-creditor relationship with the associate, no, that's not considered. The other interest has to be something which is a money which is given to the asset company and you've got no intentions of taking the money back. So as he said, the settlement is neither planned nor it is likely to occur in the future, is as good as a permanent funds. So these funds are going to be considered as permanent funds in the company. And if they're considered as permanent funds, we're going to consider them as good as equity. Okay, now let's do one thing. Let's, I think, go on to an illustration with you because this is going to be slightly technical as I kick off. And once you're going to get some jitters on that illustration after year one, I'll give you a break at that stage because I will give you a break at an appropriate time only, not at this stage. So first we'll discuss an illustration with you. Let's have a read on the illustration. So this is a beautiful illustration. I'll go step by step on the understanding. But I think let's first read this. You can see one thing very clearly on the top. There is one thing very clearly given on the top. It says loss-making associate and long-term interest. Associate. You know, when you're going to trigger the appendix, you're going to put across three questions. Number one, do you have an associate company which is a loss-making company? So do you've got an associate company which is a loss-making and you've got long-term interest along with equity shares, then this appendix triggers. It says the entity has got three types of interest in the associate. You've got equity shares, you've got preference shares, and you've got long-term loans. Now, let me first of all tell you one thing very clear. I know we have not done financial instruments, but to the extent we need the guidance, I'll give you the inputs on what is done in 109, so don't get bothered on that. This equity shares will be covered under equity method as per Ind AS 28. But these preference shares and long-term loans are going to be covered under financial instruments 109. So if you're going to invest in an associate equity shares 28. If you're going to invest other long-term receivables or other preference shares, etc. So these preference shares and long-term loans are accounted as financial instruments under Ind AS 109. And he will tell me how these investments are accounted under Ind AS 109. It says 25% equity share to which equity method of accounting is applied. And then it says non-cumulative preference shares that forms part of the net investment in associate. He's very clearly said that the investment in preference share has become a part of the net investment in associate. It's like a permanent funding and they are measured at a fair value. Now let me explain. When you consider an investment at a fair value through P&L, I've said earlier as well, so what I'm going to do in this particular case, I will consider the changes in the fair value at the end of each reporting date. Any gain, any loss on account of fair value is going to be taken in the profit and loss account, which means any fair value gain or any fair value losses is going to be captured in terms of the profit and loss. So he tells me that these preference shares are accounted at FPTPL. Then he says the loan is carrying interest at 10%. The interest is received at the end of each year, and this is accounted as per amortized cost. And he says they form part of the net investment. He's very clearly said that these loans are also a part of the net investment. They're long term. Now you would say, what do you mean by amortized cost? Don't apply your mind. What is amortized cost? But I can tell you one thing, that amortized cost accounting would mean I will be doing an impairment testing of this investment at the end of each year. If the investments are taken at a fair value, you will capture the fair value changes, increase or decrease in the P&L. But I will not consider any impairment. No impairment will be applied. If you're already considering the investment at a fair value, I don't need to capture any impairment aspects. And if you're considering an amortized cost, in this particular case, the fair value changes are completely ignored. I'm not going to capture any fair value changes if I use a cost that is called amortize. What is amortize? We'll see all that when we come to financial instruments. And in this case, impairment becomes mandatory. These will be tested for impairment under 109. So in this particular case, investments at fair value will be increase, decrease in fair value captured, no impairment. And in terms of investments at amortized cost, you're going to consider no fair value changes, only impairments are to be recorded as per 109. And he is very clearly said that both these investments are net investments in an associate, so they are permanent fundings. The appendix will trigger because we are saying, number one, you've got equity, you've got other long-term in the form of preference shares and other long-term loans, and the company is loss-making. Let's see. So this is the carrying value of each investments at the beginning, at the start of year one. And then he says, following table summarizes the changes in the fair value for preference shares and impairment loss on the long-term loan as per 109. As I explained earlier, what he says that for the preference shares, I'm giving you the changes in the fair value because you're going to capture the fair value change. And for the long-term loans, I've given you the impairment loss. And the entity share in the profit or loss of the associate is given. So what he's done, he's given you the increase or decrease in fair value of preference shares. He's given you the impairment or the reversal of impairment for the long-term loans. And he's given you the entity share of profit or loss in the associate. And you can see that there is a losses in these initial years. So there is a loss to the extent of 16 lakhs in the first year, and there is a loss and then there is a gain. Now, how does this loss coupled with other long-term interest going to trigger thoughts? No worry. It says throughout year 1 to 5, there has been no objective evidence of impairment in the net investment of the associate. The entity does not have any legal or constructive obligation to share losses of the associate beyond its interest in the associate. So I think I'm not too worried on the last part, what it says. Then he says, based on the above, determine the closing balance of each of the above interest at the end of each of the year. It's a comprehensive question. I am now required to make the valuation of these investments at the end of each year. We need to tell the examiner that at the end of first, second, third, fourth, fifth year, what is the balances of all these investments by applying Ind AS 109, by applying Ind AS 28, and also the appendix of Ind AS 28. Wow. So where we've got one investment which is equity and the other two investments are supposed to be as good as equity because it's a permanent funding. I don't know how much you might have understood the question so far. I've just read the question for giving you a basic feel, but maybe you've got some questions coming to your mind at this stage. Okay, I think fortunately nothing so far. So now what I need to do, I need to solve this question with you because I need to now explain that when these investments are accounted under 109, what is the impact of Ind AS 28 on these investments going forward? So we'll, I think, first take a break. I think it's good that we first give you a break, relax your minds, because my intellectual discussions on para number 17, 18, 19 must have also, given you a lot of insights as well. So I think before I take you to this beautiful illustration, I think it's time to first give you a break to, relax your minds. Then we're going to start with this illustration, and then we've got some very basic inputs to be given to you on Ind AS 27. Okay, so far so good. So I think let's give you a break, friends, at this stage. It's around 7:40, so 10, 12 minutes. I'll be back with you. Enjoy your break. Welcome back, friends. So I hope you relax your minds. Now I think let's do this beautiful illustration how the accounting for these long-term interest investments would take place both under 109 as well as under Ind AS 28. Now watch this carefully. So let me just first make a little run through with you. So I'm going to first explain year by year how the accounting will be done. Watch this very carefully. We're going to consider year by year how the accounting will be done. Now, at the first instance, just look at the question. This is the value of the investments, equity shares 10 lakh, preference share 5 lakh, and long-term loan 3 lakh. So we just copied this figure 10, 5, and 3 out here. Now, we need to understand one very important aspect, and that is get yourself clear in the mind that these investments for which standard would trigger. When you're looking in terms of equity share, I am applying Ind AS 28. I'm applying Ind AS 28. When I'm looking at the preference and the long-term loan, I'm applying Ind AS 109. I'm going step by step so that everything is very clear to your mind. So we're looking at, first of all, that equity shares are counted under 28 and the preference shares and long-term loan are accounted under 109 and then would also be taken under 28. Find the words. So I will first account for them under 109 and then I will also account for them under 28 as well. Now see how. If I just go back to the chart given in the question, we can see that in year number 1, there has been a decrease in the fair value of the preference share. Since the preference share are accounted at FPTPL, so you need to basically take care of the fair value change, increase or decrease, whatever. So this preference share is decrease because it's in bracket indicates a decrease. I will book that decrease. And in terms of the long-term loan, there has been an impairment loss of 50. So what I'll do, I'll first of all book the fair value change for preference and I will book the impairment loss for the long-term loan, indirectly accounting under 109. So what do? You can say this is like the step number 1. I would say this is like the step number 1. So in terms of the step number 1, you need to account for the things under 109. So equity share, of course, is not accounted under 109, so not applicable. The preference shares, fair value decrease, and the long-term loan, the impairment loss is taken, and you get the values which are after applying Ind AS 109. So your step number 1 would be that you organize the value of equity share. Nothing is to be done. But as far as the other long-term interest is concerned, you need to do the accounting under 109, take care of the fair value changes or impairment, whatever, and get the revised values post the fair value increase, decrease, or post the impairment loss. I hope step 1 is clear. Then we go to the step number 2. Then we go to the step number 2, and in terms of the step number 2, we can see that the entity share in the post-acquisition profit or loss is 16 lakh. Investors' share in the post-acquisition losses is to the extent of 16 lakhs. Now, remember one thing. We said these preference shares and these long-term loans are considered as good as equity. So they will also bear the losses out of 16 lakh, which equity cannot bear. Now, in this particular case, we can see the equity is only to the extent of 10 lakh and the share in the post-acquisition is 16. So at the max, what you can allocate to the equity shareholder is to the extent of 10. Your investment in the balance sheet could become a 0, but I can't make it negative. So what do? First of all, out of that 16 lakh, 10 lakh is given to the equity share. So this is the step number 2. This is what we are accounting under Ind AS 28. That is step number 2. This is what we are accounting under step number 2, Ind AS 28. So what we did, we gave out of 16 lakh, 10 lakhs to the equity, and therefore it becomes 0. Now the question rises, what do we do with that remaining 6 lakh? Had there been no other interest in the associate, I would have shown that 6 lakh as a part of the notes to accounts. And I would have said that we cannot absorb 6 lakh of losses and the remaining 6 lakh is being reflected in the notes carry forward to be adjusted in the subsequent years. But since you've got other long-term interest, which is as good as equity, you will adjust this loss against other investments. Now the question rises, against which investments? Well, if you look at preference shares and long-term loan, you need to understand that if a company goes for a liquidation, so who is going to get the payment first? Can I say between the preference and the long-term loan, if the company distributes the money on the liquidation process, they will first give the money to the loan holders and then they will give the money to the preference shareholders. So which means on liquidation, if a payment is to be given, I'm saying if on a liquidation, you got to make a payment, you will first pay the loan holders and then you will pay the preference shareholders. This is if you need to pay them on a liquidation. If you need to pay them on a liquidation, you will say, okay, let me first pay the loan holders and then pay the preference shareholders. But let's say on a liquidation, you need to tell them that, boss, I need to get some money out of you. I need to receive money out of you. So if there are losses, so who's going to bear the loss in terms of losses? In that particular case, between the two, the preference gets the loss first and then the loan holder gets a loss. I think, let me put it again. Every word is important, so just watch this carefully. So when the company is going to go on a liquidation, you would first of all, between the two, pay the loan holders and then the preference. But if on the liquidation, you're telling the company, telling the people who's going to bear the loss, then between the two, the preference bears the loss first and the loan holder bears the loss later. So you can say in the order of payment is loan, preference, equity. And if the money is going to be, the losses are borne, equity, preference, and loan. So we are looking at that if something got to be, losses are to be borne by them, then you're going to first tell the preference, you're going to bear the loss. So in this case, the value of the preference share is 450. So he is given a loss to the tune of 450. We've already got the value of this investment post Ind AS 109 and that is 450. So he can be given a losses to the extent of 450 only, because you cannot make the investment negative. At the max, it can become a zero. Then you can see that out of 16 lakhs, 10 lakh is allocated to equity, 450 allocated to preference. So the balancing figure 150 is going to go given to the loan holders. So this is the step number 2, that once the losses could not be fully allocated to the equity, the remaining losses have been allocated first to the preference to the extent of their book value and then to the loan holders. And therefore, this gives us the revised values after the step number 2. So you got to go through a 3-step model. So, but you've given only 2. This is right now 2. I'll give you a step 3 as well. So in order to go very safe, it is more appropriate that you go with a 3-step model, step by step. You'll not go wrong. So what do you do in this particular case? In step number 1, you first identify that equity shares accounted under 28. The other interest accounted under 109 first and then under 28. So what do you do in step number 1? You will put the fair value changes and you will incorporate the impairment loss. Any fair value changes, any impairment losses on the respective security, whichever is the measurement base, will be incorporated and you get the balance after the application of Ind AS 109. So what do? You apply the fair value changes, you apply the impairment loss, and you get the values post 109. This is step 1. Then you go to the step number 2, and it's now application of Ind AS 28. When you apply the application of Ind AS 28, you need to see that the maximum amount which can be allocated to equity is only 10. Because 16 is the loss, but investment cannot be at a negative figure. So 10 lakh goes to equity. So there is 6 lakh which is unallocated. I'm going to allocate that to the other interest because they're as good as equity. But then the question arises that this allocation will be done to whom? The way you distribute money, when you distribute money on liquidation, you tell the loan holders, you take the money first and then the preference. Which means who bears the loss in priority? The preference bears the loss first and the loan holder bears the loss next. So what do? We transferred the loss to the preference to the extent of book value. The remaining loss is allocated to the loan holders and you get the revised values post 28. I hope I am very, very clear on the agenda. Okay, so far so good. Now let's go to the step number 3. That was step number 2. Now you need to go to the step number 3, which is very crucial because step number 3 is going to act as a very good control factor as well. Is it possible that after the step number 2, there is still an unallocated losses which are left over? Yes, possible. Right now you can see that out of that 16 lakhs, entire 16 lakhs got allocated to all the interest holders, the equity, the preference, and the loan holders. So there is no carry forward portion, but still I would suggest do take a note that there is no carry forward portion. If there is a carry forward portion, please note it down in step number 3 that there is something which is carried forward which could not be allocated to all 3 equity stakes. Right? Okay, I hope I am pretty clear. So let me just quickly now go to the second year. So what do you need to do? Step 1, apply 109. I think let me just give you a documentation so that as I move to the next years, you are absolutely clear with the fundamental. So as I said, what are you going to do? You're going to solve these questions in a simple 3-step model so that no mistakes takes place. So when you're going to apply the appendix, to Ind AS 28, so there is one important factor which you need to keep in mind that when does this Ind AS appendix trigger? It triggers when there are 3 parameters. You've got equity shares, that is one. You've got other long-term interest. You've got other long-term interest as well. And in this particular case, the associate is a loss-making company. The associate is a loss-making company. So when you're looking at whether the appendix would trigger or not, get your funda clear that you got to see 3 parameters. Equity shares is there. Other long-term interest is there. And when I say other long-term interest, we are looking in terms of the preference shares, which is as good as a permanent funding. We're looking at long-term loans, and it is supposed to be a loss-making company. Factor 1, equity. Factor 2, other interest. And factor number 3, loss-making associate. Then, as I said, once you go to the appendix, you got to go step by step. So what do you do in step number 1? And then what do you do in step number 2? And then what do you do in terms of step number 3? So follow these simple 3 steps and trust me, you will not go wrong. Do try this question back home once again. Once we're done with the class today, do try it with hand. Because looking at the solution is very easy and vouching is also very easy. But when you do it with your own hands, you're a little more conscious in terms of, what we are getting there. So in terms of step number 1, you need to apply Ind AS 109. You need to apply Ind AS 109. And when you say you're going to apply Ind AS 109, you need to consider 2 factors. You need to consider 2 factors. That is, you need to consider fair value changes, increase or decrease if the method requires so. So you need to consider the fair value increase or decrease if the method requires so, and if there is any impairment or reversal. If there is any impairment or reversal, you got to take care of these factors for the respective investments. So apply your Ind AS 109 and get the values post 109. Get the values post Ind AS 109. So this is the very first thing you need to do. You need to get the values post Ind AS 109, book the fair value change, increase, decrease, book the impairment loss or reverse it, whatever the case might be. Then we go on to the step number 2, and in this particular case, we apply Ind AS 28. In this particular case, we apply Ind AS 28, and what do? You need to allocate losses. You need to allocate losses to equity. Sorry. You need to allocate the losses to equity to the extent of book value. So you need to allocate to the extent of the book value. So like in this example, we allocated 10 lakh. So we allocated the losses to the extent of 10 lakh. That is one. And then the unallocated losses. Then the unallocated losses will be allocated in the order first to the preference shares, and then you're going to allocate to the long-term loan. So you'll pass on the losses on the preference shares and then on the long-term loan. So what do you get post this? You get the values. You get the values post Ind AS 28. So you get the values post Ind AS 28 in this particular case. So this is what you need to do. Get post Ind AS 109 value, get post Ind AS 28 value. And then finally, what do you do in terms of step number 3? See if there is any unallocated losses. See if there is any unallocated losses which you could not allocate either to the preference or to the loan. Just make a note if there is any unallocated losses which needs to be carried forward, which will be carried forward. So in step number 3, you just take a note that there is any amount which is unallocated, which is going to be carried forward in the next year. I hope, friends, I am pretty much clear on this agenda. Okay, so I think with this, let's take it further. Kriti, you got a question? So Appendix Ind AS 28 means sharing of remaining losses between long-term interest? Yes. So we can say that if a company as an investor is got other interest in the associate that is other than equity shares and it's a loss-making company, tell them that your preference shares and long-term loans are indirectly in substance supposed to be equity share. So any losses which could not be borne by the equity, you're going to bear it to the extent of your book values. Right. Okay, now with this input, let's take it further. So this was year 1. Now let's go back. So I think the year number 1 must have been pretty clear. So I took the impact of 109, then I took the impact of Ind AS 28, and then the step number 3 identified that there is no carry forward with losses which are to be taken. Entire 16 lakhs absorbed. Okay, now let's go to the next one. Now we're going to the year number 2. So this value is the closing value. It becomes the opening value out here. We are now on the second year. So whatever is the closing balance of year 1, that becomes the opening balance out here. So what do you do? First of all, you apply step number 1, that is Ind AS 109. Let's go back to the question. And let's see the impact. So there is a fair value decrease, but there is no impairment in terms of long-term loan. So there is a fair value decline, but there is no impairment. So let's book the fair value decline. So we've taken the fair value decrease. That's it. So we get the values post step number 1. There was only a fair value change for preference, but there has been no value, no impairment losses in terms of loan. So we get the values post 109. Now, watch this carefully. There is a little crucial point which you need to watch out at this stage. As per Ind AS 109, you're allocating a fair value decline of 50, but the book value of this investment is 0. Now watch this very carefully. As per Ind AS 109, you're saying you got to book a fair value change, but the book value of this investment is 0 because of the application of Ind AS 28. You applied Ind AS 28 and therefore it became nil. So I cannot apply Ind AS 109. So what I need to do, in this case, I will reverse. In this case, I will reverse the losses booked in year 1. Mind the words carefully. So what I'm going to do, since I need to record the fair value change, what I'm going to do, I cannot book this because you've already booked 4,50,000 above. If I would have booked only 4 lakhs above, just imagine mathematically, if I would have booked only 4 lakh above, the value of this investment would have been 50. And if this would have been 50, I would have been able to, book this 50 fair value change as well. So what do you need to do in this particular case? You need to reverse the loss which you've taken in year 1. So indirectly, we're not going to go back and change the investment, but what we're going to do, we will say, okay, now in this particular case, that 50,000 excess was allocated. You should not have allocated 50. You should have allocated only 4 lakh. So let's reverse it. Let's see further. And as far as long-term loan is concerned, there is no challenge. So step number 1 is done. Step number 1 is done. Now we go to the step number 2, application of Ind AS 28. Now we go to the application in terms of Ind AS 28, and in terms of Ind AS 28, you've got losses of 2 lakh. The investor has got a share of 2 lakh post-acquisition loss, and if there is a loss to the extent of 2 lakh, I need to book that 2 lakh. Now see how you're going to book. I can't afford to book anything to the equity, it is 0. I can't afford to book anything to the preference share because as it is, I need to reverse 50. So equity shares, I can't allocate a loss, it is 0. Even the preference shares, I cannot allocate, rather I will reverse 50. And what happens to the long-term loan? You would allocate 1 lakh. So the 2 lakhs could not be allocated. But watch this now carefully. What are you doing? You're allocating 1 lakh and you're reversing 50. Mind the words carefully. You're allocating 1 lakh and you're reversing 50. So what is the net allocation you've done for the losses? 50. Because you allocated 1 lakh to the long-term loans, but you reversed 50 to the preference. So in nutshell, you basically allocated 50 out of 2 lakh. 50 out of 2 lakh, which means in step number 3, if I am asked what is the carried forward amount, I would say it is 1.5 lakh loss. Because out of 2 lakh rupees of loss, only 50,000 got allocated. So the remaining 1.5 lakh is unallocated to be carried forward in the next year. I hope I'm clear. So let me put that once again to you. So when you're looking at step number 1, there could be an agenda where I cannot allocate the impairment or the fair value change in terms of step 1 because you've allocated too much under Ind AS 28. So what do you need to do once you're looking at Ind AS 109 and you know due to Ind AS 109, this is becoming negative, you will reverse it in step number 2. So in step number 1, this becomes negative due to application of 109. So in step number 2, reverse the loss. So we will say we will reverse 50 and we will allocate 1 lakh. So the net allocation of 50 out of a total of 2 lakh of loss. So 1 lakh 50 is the loss which is carried forward. I hope, friends, I am clear. Okay, that's great. Now let's take it further. This was year 2. So we know now what is the balances after the step number 2. And we also know what is the carried forward loss. Now let's go to the year number 3. Now let's see the year number 3. Now in terms of the year number 3, we got to consider the opening balances. The previous closing becomes the opening out here. Now comes another interesting challenge. So what they did in the first year, allocation of losses, and there was no carry forward. What happened? Unique in terms of the step number 2 is a reversal, and there is unallocated losses. So you can see 2 things in the year number 2. Reversal amount is there, and there is also a challenge in terms of carry forward losses. Now let's go to the year number 3. So I'm going to first apply Ind AS 109. Now there is a plus increase in the fair value and there is a plus reversal of impairment loss. In the third year, there is an increase in the fair value, book it. There is a reversal of impairment loss, book it. And we don't have any losses in this year. Great. So let's do one thing. So what do? You first of all go to the step number 1 and in terms of the step number 1, you apply 109. You book the fair value gain out here and you book the reversal of impairment loss and you get the balances post the step number 1 that is after 109. You book the gain, you book the reversal of impairments and you get the values based on the step number 2. Now we go to the step number 2 and that is we need to apply Ind AS 28. But before you apply Ind AS 28, you need to keep a track that in the previous year, was there any carried forward loss or not? That is the reason I'm doing the step number 3. So when you go to consider the step number 2 at this particular stage, you need to go and take a track that if there is anything which was there in step number 3 carried forward in previous year, that is in year number 2. So we'll go back and see that in year number 2 was there a carry forward, there was a loss of 1.5. So we're going to first of all take that. Now, in this year, what you would do, right now, there is no current year losses in this case. Otherwise, what I will do, I will allocate number 1, the step 3 carry forward loss of previous year and the losses of the current year. I put it again. In this particular case, what I will do, I will take care of the carry forward losses in the previous year and also the losses in the current year. Both have to be taken into account. So in this space, only 1,50,000 is there. So what do? You first allocate the loss to the preference, and then you allocate the loss to the loan, and therefore it becomes nil. It's a beautiful chance that they become nil. So first you allocate the amount to the preference to the extent of book value, then the remaining is allocated to the loans, and that is up to the extent of market value. You get the values post step number 2, then you again go to step number 3. Then you again go to the step number 3. So there are certain criticalities which you need to keep in mind in terms of step number 2. So what are the criticalities, what you need to keep in mind in terms of the step number 2? Let me remind you out here. When you're looking in terms of step number 2, the critical point which could bother you is, in terms of step number 2, the critical point which would bother you at this stage is that you need to allocate, you can say, the losses carried forward from previous year and the current year losses both. So this is the critical point which you need to consider when you go to the step number 2. That when you're considering the allocation of losses, you need to keep a track that if there is any unallocated losses of the previous year plus the current year losses, both needs to be allocated in terms of step number 2. And there is another crucial point which you need to consider in terms of this step. There is another crucial point which you need to consider, and that is if due to 109, there is a negative balance, you need to reverse. So you can say if due to Ind AS 109, we get negative balance. If due to the position of Ind AS 109, you get a negative balance. Like, remember in the second year, we got a negative balance of 50. So there was a negative balance which is coming due to the application of Ind AS 109. So what do you need to do? You need to reverse losses allocated under 28. You need to reverse the losses allocated under Ind AS 28. So this is another important input what you need to keep in mind. So that is getting very technical indeed. Don't worry, you can have the option of watching this once again and get your fundas absolutely clear, because right now we're doing a question which is a very safe question with no, lefts and rights in the question. But I think you need to be crystal clear in terms of what you do. So the critical points back on step number 2. When you're looking at step number 2, you need to be careful that the allocation of losses is equal to the sum total of the previous year carry forward loss and also in terms of, you can say, the current year losses. That is one focus point. The second focus point is that due to Ind AS 109 application, once you are getting a negative balance in step 2 to begin with, because in step number 1 you're getting a negative balance to begin with, you need to allocate. You need to, reverse the losses which you have allocated under previous step. That's what we saw in year number 2. Okay, so let's take it back. So now let's see what is the position. In terms of the step number 3, I think there is no loss carried forward because entire losses have been allocated now. So there is no loss which is carried forward. So year 3 is done. Now you go to the year number 4. And in terms of year number 4, the closing becomes the opening balance, which is 0. Then again, step 1, 109, step 2, 28, and step 3, same procedure. So here we apply the step number 1 in terms of Ind AS 109. let's go to the question back again. So if I look at in terms of Ind AS 109, now we can see in the fourth year there is a fair value gain, but there is no impairment or reversal, just a fair value gain, and there is a profit. Now the question arises, who's going to get the profits as well? Till now you've been working upon allocation of the losses. Now you're going to work upon the allocation of the profits as well. So interesting. So book the fair value gains. So what do? In step number 1, you book the fair value gain and you get the values post Ind AS 109. In this particular case, there was no carry forward losses, and that is in step number 2. And we can see that there is no negative balances, so no critical points. Now comes the step number 2. Now comes the step number 2 in terms of Ind AS 28. Now watch this carefully. When there were losses, you told equity, you bear it first. And then you told the preference, you bear it next. And you told the loan, you bear it next. So the losses were borne by equity to begin with. And then it was borne by the preference. And then it was borne by the loan. So when it came to bearing a loss, you said equity, you bear the loss. And then preference, you bear the loss. And the loan, you bear the loss. But if it comes to distribution, who gets the money? The loan gets the money first. The preference gets it second, and the equity gets it third. So in this particular case, if the money is going to be distributed on liquidation, you'll give the money to the loan holder first, then to the preference, and then to the equity. But you will now give this gain of 10 lakh up to the extent of losses allocated. You can't give them more. Because the loan has borne a loss, you need to go back and see what losses has he borne. So you'll have to go back to year 1, year 2, year 3, all 3 put together and see what losses have been allocated to the loan so far. In the year number 1, you allocated to the loan a loss of 150. Let it note it down. So in the first year, you allocated a loss of 1,50,000 to the loan. In the second year, you allocated another 1 lakh to the loan, so 250. And in the third year, you allocated another 50,000 to the loan. So what you've allocated so far in 3 years is 3 lakh. So give him 3 lakh first. Give him 3 lakh first. See what was allocated to him in year 1, 2, 3. So whatever is the allocated losses, first give him his gain. Then similarly, let's go to the preference. In terms of preference, you gave a loss of 450 in the first year. But then you reversed 50, so minus 50, allocation is 4 lakh so far. And you allocated another 1 lakh in this case. So the total losses allocated is 5 lakh. Year 1 was 450. Year 2 was reversed by 50, makes it 4, plus another 1 lakh, makes it 5. So you allocate him 5 lakhs. So we are allocating the gains first to the loan holders and then to the preference shareholders. And out of the 10 lakh, this is the balancing figure which goes to the equity. Now this has resulted in reversal of all the losses back to them. The losses allocated to the loan holders, the losses allocated to the preference, everything has been reversed back. Everything has been reversed back and you get the values post step number 2. Now what do you need to do in step number 3? Now, in terms of this, you need to go to step number 3. Now, it is not a case of loss. It's a case of gain. So here, in terms of step 3, I would say slightly make a little change. Instead of looking at what is the carried forward loss, start looking at who could not be compensated. Look at who could not be compensated. Look at the fact who could not be compensated. So you need to consider who could not be compensated. In this case, it is 0. Because you've been able to reverse the losses allocated to each one of them. But I think equity, I don't think so. He's been completely allocated. Let's have a look at the equity. Can I say equity allocation first year is 10 lakh. Second year, there was no allocation. Third year, there was no allocation. And he's been given a loss to the extent of you can say 2 lakh so far. So there is a pending loss of 8 lakh towards equity as well. So there is a losses of 8 lakh which is not yet allocated to equity. which means when the next lot of earnings will come, I'm going to give him first 8 lakh. But trust me, after that, everything is to be given to him. Because in this particular case, since he is only left over, whatever gain comes goes to him. But you would also imagine that, let's say, in this case, you could not completely, reverse the losses to preference. In the next year, you would have first given the shares to the preference and then to the equity. It becomes a very safe question that in this case, since everybody except equity is compensated, you can simply compensate the entire 8 lakhs to equity. I know you must be thinking this is really, really technical indeed. Okay, Mancha said, so please explain once again the reversal of 50 in the second year. Okay, let me put that once again. I'll just quickly run the parts again to you, and we'll just quickly take a run through after that. Okay, so this is done year 4. Now we go to the year number 5, and in terms of the year number 5, you first pick up the opening balances. The closing of the previous becomes the opening of this year. So in this particular case, again, you apply the step number 1. And when you apply the step number 1, you're going to go back to the chart. There is a fair value gain of 30. There is no impairment or reversal, and there is a gain to the extent of 10. So we're going to book that fair value gain of 30. That's it. So let's book the gain of 30. So we book the gain of 30, and this becomes the value post 109. So there is no impairment or reversal. So just book the fair value gain, and then we go to the step number 2. And in terms of step number 2, we need to apply 28. Step 1 was 109. Step number 2 is 28. There is a gain to the extent of 10 lakhs. Since he has been, given a loss of 8 lakh, everything goes to him. You give him that 8 lakh also, and the remaining 2 lakh also, because, sorry, other than him, so we can say other than him, everybody has been compensated, so he gets entire 10 lakh. And then if you go to the step number 3, there is nothing which is left over, because there is no carry forward losses, and there is no loss which is not yet compensated as well. I think this was a very technical question indeed, but you must do this by your own hands. Unless you do it by your own hands, trust me, you're not going to get confidence, and you must do it with own hands. Let me just answer the question, Mansha, you had on the second year. Now, let's get the second year crucial point once again, and the point is, your opening balance before the step number 1 is 0, and you want to book a impairment loss or a fair value decline. Mind the words carefully. In step number 1, your opening balance of the investment is 0, and you need to book a fair value loss or impairment, but I can't do it because it's 0. Still book it. Still book it. Tell him that this becomes negative 50. I'll take care of this in step 2. So in step 2, when you do Ind AS 28, reverse it. So what do you do in step number 2? Since you have allocated excess loss in the previous year, reverse it. So you're allocating 1 lakh to the loan, you're reversing 50 to the preference, the net allocation is net 50. So in step number 2, you need to be careful that if you get a negative balance post 109, mind the words, if you get a negative balance post 109, you need to reverse the losses which you booked under 28 earlier. That's what you're going to do in step 2. And the crucial point in terms of step 3 is keep tracking the carry forward losses which are there. And once the carry forward losses are there, keep tracking who is yet to be given the loss, who is yet to be compensated for the loss. Right, friends. So I think that is the appendix, and we are done with the illustration on this. Okay, you said in year 5, 8 lakhs should be allocated to equity instead of 10. Well, in year number 5, since you have already allocated the losses to the loan and preference, there is no amount which needs to be compensated further. What you need to keep in mind is the loan and preference were given back and compensated the losses they borne earlier. So you give 8 lakhs to this fellow, then the remaining 2 lakh also goes to him. So you give him 8. Now let's say In the previous case, there was still some, losses which could not be compensated to the loan or preference. I would have given out of 10 lakh the gains to those fellow to the extent they could not be compensated, and the rest goes to equity. Right? I hope I'm pretty clear. I don't think so that you'll get a 100% hold after looking at this illustration, but once you're going to do this with your own hands, touch me, once you're going to do it with your own hands, you get a track in terms of what is to be thought in step one. They've given you the crucial inputs. Do it with a simple 3-step model. Apply 109. Irrespective, it results in a negative figure or not. Go to the step number 2, and in this case, if it becomes negative, remember to reverse. And if it is positive, remember the order in which losses are to be distributed. Then step 3, get the carry forward losses which you could not allocate. And let's say if you reach a profit stage, then in step number 2, remember the order in which profits are allocated. And once you get a profits in step 3, instead of getting a carry forward loss, try to get what is the loss which could not be compensated. And that will make life simple. Right, friends, I think before now we go to the last area, that is Ind AS 27. Ind AS 28 is done. Now, a little inputs on Ind AS 27, which is pretty easy. We've done some discussions earlier as well, but I'm just going to quickly run through in the next 15-20 minutes on 27 with you. But let me get your comfort zones on a scale of 10 on this particular concept, appendix to the Ind AS 28. Give me your comfort zones on this area. And in the meantime now, let's come to Ind AS 27, which is pretty easy. It's a pretty easy standard from the examination point of view. Practically, there has been, I think, no question so far also which has come on Ind AS 27 in the exam, because I think this is perhaps a little too simple to come. Okay, so let's, I think, take it further. And in the meantime, do send me your comfort zone scores on the appendix if you feel so. And I got a score 9. Kriti, wonderful indeed. Claire Tahir, great, wonderful indeed. Okay, now switch off, switch on, and we're going to Ind AS 27. And let me, I think, make the position very clear. Now, as far as Ind AS 27 is concerned, I had said earlier as well, and I'm going to reiterate this once again before I read any inputs to you. So let me just, I think, give you the inputs. Let's say, for example, there is a company A and it has got an investment in a subsidiary, or it has got an investment in a JV, not JO, or it has got an investment in associate. Mind the words carefully. I'm saying if there is a company A which has got a control over one company, joint control resulting in a JV, and a significant influence resulting in associate. In this particular case, A, as I said earlier, will be required to make 2 financials. One is separate and one is consolidated financials. Well, if you remember, even when we, started the journey on 103, the very first class, when I gave you the permutation combinations on which standards would trigger, I very clearly told you that if you've got investments in these 3 related parties, it is only then Ind AS 27 applies, not otherwise. So the company, when making these separate financial statements, would be reflecting these investments at a cost or at a fair value as per 109. The standard Ind AS 27 gives them a choice, and they say that when you're going to record these investments in the separate financials means where you will reflect investments in these companies. So when you're going to reflect the investments in these companies, you will choose either a cost model or a fair value model. And let me tell you something more. If you choose a cost model, it is subject to impairment testing under Ind AS 36. I know I might be speaking a bit technical, but I think I need to give you some inputs. So if you're going to apply the concept of a cost model, the standard makes it very clear that this is subject to impairment testing. It is subject to impairment testing, and that is as per Ind AS 36. I'll be coming to this part again when I come to financial instruments with you. I'll remind you this again, that investments in related party are thrown out of 109. The standard Ind AS 27 says that you cannot apply Ind AS 109. You need to consider them at cost. So impairment testing will be done under 36. But you can still choose to apply a fair value under Ind AS 109. Though in a practical life situations, you will never see a company considering investments in related parties at a fair value. Though I saw one of the companies, if you want to watch out, there is a company, Videocon, and before they went into insolvency, have a look at their balance sheet. They were taking investments in related party as per Ind AS 27 using a fair value option, which is dangerous. In a very idealistic situation, pick up companies, listed companies. You're going to see, though there is a choice between the two, companies prefer a cost model for related party with impairment testing under 36. But if you choose a fair value model, then let me also tell you that impairment testing is not applicable. The impairment testing in that case is not applied. So the concept of separate financial means investments in subsidiary or investment in JV or associate. Cost model, impairment testing under 36. Though there is a choice under fair value, but technically you should not apply and the impairment testing would trigger. Now, when it comes to consolidate financials, you would apply Ind AS 110 to consolidate a subsidiary. You would apply Ind AS 28 to consolidate a JV and Ind AS 28 to consolidate an associate. So A would consolidate a subsidiary using 110, associate and JV using Ind AS 28, unless exceptions apply. Now there is a beautiful illustration which is given in the study material, which I like to take you through, because that throws a little good light in terms of which standards would trigger, whether Ind AS 27 would trigger or not. But remember, Ind AS 27 triggers only when there is a related party investments. If you've got a passive investment, which is neither a control or a joint control or a single influence, Ind AS 27 will not trigger. So let's have a look at one of the illustrations which is given. This is a beautiful example. So let's have a look at this example which is given in the study material. So let's have a look. Now this will take your knowledge in terms of the exemptions, exceptions you've done under Ind AS 110 para 4A as well as investment entity, and would also take your thoughts in terms of the para number 17, 18, 19 of Ind AS 28 as well, what we've done today. So your entire understanding in terms of the exemptions and exceptions will come into play. Beautiful illustration which is given on this standard. Okay, we got a score 9-7, need to revise tonight. Great, 10 by 10, Tahir. Okay, I think 2 questions coming in. Separate financials and standalone financial statements are one and the same thing? No. No, I think, let me clarify that. When you're looking at a separate financial statements, it is not a standalone financials. So you can say that if a company A has got investments in associate, JV or subsidiary, you make separate. And if you've got, investment other than these three, just a passive investment, you call it a standalone. So those financial statements which are your individual, or you can say standalone financials, are prepared when you're not making any console. And typically there can be cases that you do not make a console, but still you're preparing an SFS. But remember, the concept of SFS applies only you've got a control, you've got a single influence, or you've got a joint control. If you've got no relations out of these three, it is called standalone. Right? Okay, Tahir, you said impairment testing should be checked every year or every quarterly if interim financial reportings are applicable. Well, the concept of impairment testing under Ind AS 36 is based on indicators. And we know that once there are indicators of impairment, it is only in those cases we do impairment testing. And there are exceptions where indicators of impairment need not be present. So you can say indicative, and if the indications are there, yes, it would apply to interim reports, and it will also apply to the, you can say, annual listed financials as well. That was a good question indeed. Okay, so I think let's come back to this illustration now. Now let's have a look at the permutation combinations and watch this carefully. So I am given. It says a parent is a listed company, top of the chain. There is a subsidiary A and there is a subsidiary B. But for B, it says it has availed the exemption from preparation of consolidated financials as per para number 4A. This company is not required to make a consolidated financials, though it was, but it availed a choice. Right? It was, but it availed a choice. Now, let me ask you. In this particular case, if I look at subsidiary, okay, let's, I think first read it further. This is an associate of the parent, and this is an investment entity 80%. And then we are given further inputs. This is subsidiary, 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 subsidiary. But there is an asterisk out here which says S does not provide services that relates to investment entity D's activity. Now let's make a walkthrough in terms of which company makes an SFS and which company makes a CFS. Let's go one by one. Can I say, as far as the parent company is concerned, yes, it will make an SFS and CFS both, undoubtedly. It is going to make a separate financials because it has got subsidiaries and it has also got, you can say, associates and all. So in this particular case, separate and consolidated financials definitely applicable. Now let's look at the last chain. If you look at these companies, PQRS, they are not having any investments in any company. These companies are not parent of anyone. They are not having a joint control or a significant influence in other company. So none of these companies would apply SFS. None of these companies would make a consolidated financials. So I think you can guess, what are they going to do? They're going to make standalone financial statements. They're going to make standalone financial statements. Because in this particular case, these companies do not have any investments. They do not have any investments in a subsidiary or an associate or a JV. So they are not required to make either separate under 27 or consol. They're going to make their standalone, or you can say the individual financials. Now let's go to A. If you look at A, it is a middle company in the chain. And if it is a middle company in the chain, para number 4, E is not applicable to this company. So if it is not applicable to this company, he would make a separate and consolidation both. He will be consolidating the subsidiary as per 110, and he would also make a separate because he's got investment in a subsidiary. If you now look at B, B is a company which is getting an exemption under 110. So he would not be required to make console, but he would definitely make separate. He would definitely make separate because he is getting an exemption under 110 not to consolidate as per para 4A. So console is exempt, but he's still got a subsidiary. If he's got a subsidiary, he is required to make a separate financials as well. Now let's look at the associate C. Can I say in this case, he's got a subsidiary, so he would also make a separate and a consolidated financials both. The moment a company has got a subsidiary or a JV or an associate, separate would trigger for sure. You may give an exemption on consolidation. So you can see this case, console and separate for a subsidiary. This case, console and a separate for the associate. He's consolidating his subsidiary. He's consolidating his subsidiary. He is not consolidating because of exemption, but separate is still there. Now let's look at investment entity D. Now D has got a subsidiary. He is investment entity. S does not provide services relating to D. Since if the services would have been same, I would have consolidated. But if the services are not same, no consolidation. So in this particular case, separate would be a yes, but consolidation would be a no. Because in this case, he would be getting a mandatory exception, a mandatory input from 110 that you're not going to consolidate this subsidiary based on a three-step model. So you can see that our discussions on the para number 17, 18, 19, the para number 4A, and the concept of para number 4B of 110 has been very crucial to get a clear-cut idea on this part. So we can have a look at the solution which is given out here. So there has been a solution which is given out here, whether these companies will be required to make a separate and a console or not. The parent company, yes, for a console. The parent company for a separate is a yes. That's what we said. Subsidiary A's console is yes, but this is no. Why? He's getting a choice under para number 4A of Ind AS 110. He's getting a choice under para number 4A of Ind AS 110. So no console, but separate is being prepared. So you may make a console and separate both. You may not make a console, but still you might be making a separate. रिश्ता है. रिश्ता जब तक रहेगा तब तक separate financials बनेंगे. Console is no, but separate is yes. Associate company, yes, they're consolidating the subsidiary. Investment entity, console, no. Why? Because we're applying the three-step model. We're applying the three-step model as per the Ind AS 110. He is an investment entity. His subsidiary is not an investment entity, and neither the services relate. So no console, but separate is still done. So you can see this is one combination, separate, no console. This is another combination, separate, but no console. And you can see the bottom companies, PQRS, the console is a big no because they don't have any relation. And are they going to apply Ind AS 27? No. These entities will prepare their financial statements as per the Companies Act, but they will not be termed as separate financials since they do not have a subsidiary, associate, or a JV. So in a nutshell, we can say that the concept of Ind AS 27 triggers only and only if when you've got a subsidiary or an associate or a console. So we can say that if you've got a subsidiary, if you've got an associate or a console, you will definitely make a separate. You can see. You're definitely making a separate financial statements. You may be making a console or maybe exempt. But one thing is very clear, if I give you an MCQ, and I say that if a company has got a subsidiary which may or may not be consolidated by 110, you got an associate which may or may not be consolidated under 28, but would Ind AS 28 apply to you always? The answer is a big yes. And if you do not have a subsidiary, associate, or a joint venture, would Ind AS 27 apply? No. In those cases, neither separate nor console, but you're going to make only what you can say is a standalone, or you can say individual financials, but we will never call it as a separate financials. Ind AS 27 would not be applicable. Right, friends, I hope I am pretty much clear on that agenda. Okay, I got a question, Kriti. Standalone financials means normal accounting, like in case of joint operations, and separate financials means as per 27. Yes. You can say, our perception of financial statements has always been standalone, separate is same. It is not. So today, I think I'd like to, just make a little clarification once more in a go. If there is a company A, you got investment in subsidiary, you got investment in JV, you've got investment in associate. Separate financial statements, 100% applicable. I would say separate financial statements, 100% applicable. You will definitely follow Ind AS 27 irrespective. You consolidate the subsidy, you consolidate the associate or not. Doesn't make a difference. If you look at a consolidated financials, it may be a yes or no. It may be a yes or no. It may be a yes or no. Because this status depends upon the exemptions and exceptions. But separate would be a yes. Now you look at another case where you say it is neither of them. It is neither of them. Neither of them means it is supposed to be a passive investment. So neither would basically mean that it is supposed to be a mere passive investment. And if it is a mere passive investment, separate financials not applicable, consolidation not applicable, we are just going to make a stand-alone financials. But they're not 27. This is the crux in terms of things. And Mansha said, but A is listed and cannot avail exceptions. Yes, A was on the top of the pyramid, I guess. A, okay, you mean to say A is not listed. We were looking at the parent being listed. So A is not listed. We're not given that A is a listed company. We're given the parent on the top is listed. Top company, listed company, chain holding never gives you an exemptions. That we're done. Right? I hope, friends, I am pretty much clear on the agenda. So this was the main issue in terms of Ind AS 27. There are a few more things which are given on 27. So you could just read it through. I've given you the major crux, what is important on the standard from the examination perspective. That takes care of the chain in terms of entire consolidation. We've covered 103, we covered the trail of 110, we covered the trail of 111, we covered the trail of 28, we covered the trail of 27. So 4 major standards covered on consolidation. Now you should do a complete comprehensive revisions on all these standards put together. Because the weightage in terms of the examination, undoubtedly you're going to get questions out of these area. So you might get one question, maybe the first question itself on 103 or maybe 110. So this is one major thing. Now, next class, we're going to start with a very interesting standard, and that is called financial instruments. And we're going to devote a good number of classes also because this is a technical standard. And that's again very important from the examination point of view. So we've got almost like 10 classes going on financial instruments as well. Right, friends. So I think it's time that we ask you if you've got any questions to ask, please go ahead. Otherwise, I think we are done for the journey today. Thank you, Kriti. Thank you so much indeed. So my advice would be to please make one console revision on all these standards. And at least you know what we've done in the appendix today. Do try this by hand. You'll get definite confidence for sure. Okay, so I think that's it. It seems to be no further questions coming in. Let's just see if there is anything further. Okay, so I think then it's time, friends, to bid you goodbye on that. So it was a pleasure. So we're going to meet you in the next class, starting with financial instruments. Thank you very much. Good night. Take care and bye-bye.